Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor, speaking to you from New York City on the 25th day of June, 2019. And I like to always remind you that I'm the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. It's gaining some recognition now for sure with the gold prices rising somewhat and gold shares looking better. So you might want to consider taking at least a trial subscription to my newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. You can go to miningstocks.com to sign up for that. miningstocks.com or call our phone number here in the office during our regular work hours, 718-457-1426, 718-457-1426. Also like to put in a plug for Chen Lin, chenpix.com. Chen is away on vacation with his family in Beijing and Australia and a whole lot of places in the Far East, but he'll be back in another few weeks, and we have to have him on our show sometime to tell us about what he saw over in Asia. But chenpix.com, that's where you can go, chenpix.com, to buy his subscription to his letter, which is called What is Chen Buying? What is Chen Selling? And, of course, Michael Oliver, it's olivermsa.com. We'll be talking to Michael in just a minute or two. I do want to thank all of you for listening to this show, making one of the more prominent shows on the Voice America Business Channel. And keep your questions and comments coming along to questionsfortaylor@gmail.com. Questions, the number 4, Taylor@gmail.com. Also want to thank our sponsors for making this show economically viable, and I do want to welcome Radisson Mining Resources as a new sponsor to our show today. In just a few minutes after our first commercial break, I'll be speaking with Hubert Parent-Bouchard of that company, and he'll be explaining why you may want to take a close look at the shares of that company, as I have. I own them, and that company is a recommendation in my newsletter as well. Other sponsors for today's show: Klondike Gold, Novo Resources, RN Resources, and Strike Point Gold. I've titled today's show Currency Wars, Rocket Fuel for Gold. John Rubino, Michael Oliver return. As I mentioned, Hubert Parent-Bouchard of Radisson Mining Resources will visit us for the first time. Radisson Mining has a high-grade gold deposit in the prolific gold-bearing Cadillac Gold Camp in Quebec. It is a stock that I, as I just mentioned, personally own and is also in my newsletter. One I think is hugely undervalued, one that most people are certainly not aware of yet. But I think as more money comes into the mining sector, those are the kind of names that have a chance to rise very dramatically because they're such small companies, and they have those that have real prospects behind them, I think, can rise very dramatically, and I do think that Radisson Mining is one of those. European Central Bank Mario Draghi has been forcing the dollar higher by his all-it-takes strategy to generate European growth. But that policy has ramped up currency wars by giving the Eurozone an advantage in international trade. President Trump has let it be known that he's not happy at all about that. He won't accept the continuous debasing of the euro any longer, nor can the Eurozone print euros to buy American corporations, as the Swiss central bank has done. Trump is letting all those nations know that he's not going to be happy with any of that. With the global tariff fight and currency devaluation in play, visions of the 1930s are reappearing. The winds of a competitive currency devaluation may be at least part of the reason that gold has finally risen above that 1360 ceiling that had held the yellow metal down over the past 5 or 6 years. Well, John Rubino will be with me in the second half of today's show to discuss global and domestic issues that appear to be responsible for triggering a higher gold price. And we will also want to ask him for his outlook on the markets through the remainder of this year. And right now, and right after the first commercial break, as I mentioned, Hubert Bouchard will be with us to talk about Radisson Mining. But right now, I'm really happy to tell you that I have Michael Oliver with us, olivermsa.com. And Michael is one of those people that doesn't say, well, I think gold is going up because Trump said something or this or that. No, Michael looks at the real internals of the markets, the momentum of markets, much more reliable. He's not going to try to opine on what is driving a given market, but try to pull everything together and see what the message of the market is, what the message of the markets are telling him. And that has proven to be very reliable, which is why we really like to have Michael on every week if possible. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Good to be back, and I want to start out by quoting a friend of mine who writes a very popular website, 321 Gold, Bob Moriarty, who suggested that with gold rising so fast, we should be ready for a bit of a pullback. And Bob is concerned that the yellow metal is just a bit that the sentiment has gotten a little bit overcooked, and who knows? I mean, gold has come back a bit today, but now I see it's bouncing right off of where it was yesterday at this hour. What are your thoughts about this idea that gold is perhaps there's too much positive sentiment for gold?
Well, I'm not a sentiment guy, meaning a contrarian. I saw some metrics on sentiment going back like a decade, with numbers affixed to the price chart of gold showing what the overall commitment of traders was and sentiment and so forth. Over the past 10 years, it had both highs and lows. And one of the numbers I saw that was stunning was a few months ago when we were down in the doldrums, remember, under 1,300. Despite the fact that gold had exploded off the August 2018 low up to, above the 1,300 level, sentiment didn't rise in any way that was reflective of a bull push that you'd seen at previous surges in gold over the last 10 years. In fact, the sentiment, even at the best levels after that late 2018 surge, were nowhere comparable. In fact, they were almost comparable to some of the lowest readings we'd had. So I don't tangle myself up with that. I used to give a seminar on issues like that, including contrary opinion, and I'd show a cover of Money magazine from a distance to people in the audience, and there was a couple looking up in the sky, and the headline on Money magazine said, "You too can get rich on .com stocks, tech stocks." This magazine was issued during that period back in 2000, but they couldn't see the date on the cover. The audience couldn't.
Yeah.
In fact, the date was March 1999. If you're walking down a grocery aisle and saw a Money magazine cover that hit you in the face like that, you'd say, "Oh, gee, there are too many people bullish." Yeah. Well, the bull market, in fact, and the tech stocks, the .com stocks, continued to explode for the next 9 months after that magazine cover was issued. So, I pity the contrarians who shorted the .com too early. Anyway, so I sort of don't get involved in that. I'm not really interested. Also, I think some of the technical metrics that people look at for what's overbought or not overbought are based on actions of the past several years, which have really been stuck in the doldrums, if you stand back and look at the chart, the gold chart. And therefore, the metrics, which are based on several years of prior up and down metrics, are too contained. They don't reflect a potentially explosive market that would blast all of what used to be overbought off the page. And I think we've started to see that. It's an upside crash in gold, effectively, and I think that what was overbought 3 months ago, 6 months ago, 2 years ago, forget it. We're in a new reality.
Right.
We're in a new reality. So,
well, for sure,
will have corrections and so forth, but they're not going to come from your normal overbought levels. They're going to come from, for instance, GDX. 10 consecutive up days in a row we just had. Yeah. So finally get a down day today. Wow, what a surprise.
Yeah.
Yeah. We're in a new reality.
And my son Scott sent me an article earlier today talking about how so many people are just really disbelieving this rise in gold. They can't really believe that it's for real. So I have to think that
that's good.
That, a lot of people, of course, have come free. The people that were, every time gold would hit up against 1360 would bounce off. Obviously, some people have now bought into the notion that gold is on a run, but it would seem to me to be an awful lot of people who aren't into gold yet, I would think. And speaking of that, let me ask you about the equity markets, because I know you've long held that they're probably for gold to have a real big run, it's going to need to see money coming out. At least the gold shares will be the benefactor of money coming out of the equity markets. You still feel that way? And if so, what do you see for the gold for the equity markets?
We've seen these aren't gold bugs buying GDX and the miners within there. Okay, this is outside money flows, no doubt. The worldwide asset managers suddenly waking up to the reality of the gold market is the alternative, another alternative other than government bonds.
Right.
And I think that flow has begun, and even rallies in the stock market, the S&P, for example, don't discourage that view. In other words, they've shifted already. You can't smoke them with an S&P rally. But I do think that as the S&P caves, and we have a situation now you got to pay attention to. Since January of 2018, when it made a high just short of 2880, S&P 500. Okay. Since then, we made a high in September 2018 at 2,900 plus. Then we made a high several months back at 2,950. And then we made a high last week on summer solstice, interesting, at 2,960. Now, how come we keep making, quote, new highs, and yet there's no traction?
Right.
Pretty soon, the bubble believers are going to wake up to the fact that every time they surge back up and make a new high, they go like 1% further or 0.5% further, and then suddenly they collapse several hundred points. It's going to soak into their minds pretty soon. I think this retreat we're seeing right now has to be watched carefully, because I think if you get down a couple percent below where you are now, and we provide specific numbers in our reports, obviously, you're going to have a situation where the believers are scratching their heads, saying, what's wrong here? How come we can't get an explosion out of this market, taking out the prior highs? Gold took out some prior highs and exploded. Okay,
right.
S&P didn't. And suddenly we're back down today within 1% or 2 of the January 2018 high in the S&P.
Right.
So what's going on here?
Yeah.
I think if money leaves that market, it will go to the miners. Yes.
It looks like a gigantic top here to me over the past few years, almost. When the equity markets.
I think it's a bit wider than most tops, but
it's wider than most. Yeah. Well, we've seen it before in history, of course. With a couple of minutes left here, Michael, what about GDX and the gold shares? I noticed earlier today the gold shares weren't doing. They seemed to be weaker before the gold price got a bit weaker. What do you think the gold shares would be leading us? Should we keep gold shares as an eye to where gold is going?
No, they're still the wild dog on a leash, Pinkanese or whatever, rushing ahead and rushing behind. But I think now they're distinctly in the lead. And the fact that today is down, again, we had 10 consecutive up days in GDX, some of which were stellar up days, not just incremental. Stand back a little bit further and look at the close of May, where gold was and where GDX was. GDX right now, just before I came on the show, was up almost 19% on the month.
Wow.
17 trading days at 19%. What's gold up? 9%. Okay, which would you rather be in? Okay?
Yeah.
So I think taking it day to day is a mistake.
Right, for sure. Would be.
The big picture is spoken.
Absolutely. Real quickly, Michael, you've been really bullish on the grains. With all of this bad weather going on in the Midwest, I'm wondering, are you bullish still on the grains, or are some of the trade issues maybe offsetting that?
The grain category as a major food segment of the commodity complex has been laying in the weeds for several years, laying at what I call theoretical zero, meaning they got pounded so hard from 2011, 2012 highs down to price levels that effectively were just as far as they were going to go down. They weren't going lower. They're not going to zero. Mm-hmm. So, corn at $3 and soybeans at $8 or whatever, and they just go sideways. They have thrashing rallies that fail, they come back down, but they don't go anywhere on the downside. So what they were saying for the last several years is we're through going down. The only issue is when do we turn up? Mm-hmm. And we've had enough evidence out of wheat and corn in this rally, which we pegged pretty well about a month ago, say to us that no, that was the low. We're now engaged on the upside, and we're still at very cheap prices historically. Soybeans were a bit lagged for obvious reasons. We had the China deal when it was the soybeans were critical there, but they're engaging now as well. So I think the food complex, especially the grains, is ready now to be one of the leading parts of the commodity complex in the next upside in commodities. And I also think that the copper and oil, for example, which led the upside a year or two ago in the commodity complex, will now, while they've been negative of late, copper and oil, reflective of the S&P to some extent, I don't think they're going to contribute much on the downside in terms of detracting from the upside in grains. So as the grains turn up, gold's turned up, as gold's obviously in the leadership position there. Sugar, cocoa, coffee turn up. The negatives from oil and copper will abate, and I don't think there'll be a drag on the overall complex.
All right.
So we're looking for a broad commodity upturn as well.
All right. For the rest of this year, probably, and into 2020, I suppose. Huh?
Probably. Lovely.
All right, Michael, we'll have to leave it go at that. Thank you so much again for sharing your time and your thoughts with us. Always appreciate it, and we'll look to have you again next week if you're available. Thank you so much.
Thank you.